I think it'd be disappointing if we don't see at least 150K. I'm hesitant to give a much higher price targets because you could certainly reach there. But I try to take, one step at a time. And so I think that by most metrics, I'd be surprised if we don't see another, you know, 30+% move, or more that would get us up to that kind of, that higher level. There are certainly higher numbers that I wouldn't be surprised at all. I'll reassess if we reach those numbers to see if there's still more to go. But basically, I think we're in a longer cycle, maybe less extreme, but still, summers and winters, still bull markets and bear markets. And I tie them less to the 4-year halving cycle and more toward pockets of euphoria, pockets of depression, as well as the supply demand cycle. So what kind of higher prices unlock older coins, and what kind of consolidations stop those older coins from getting to the market? I'd say most metrics suggest higher from here, moderate, at least moderate.
Lyn Alden opens with a powerful thesis. Bitcoin's market structure is changing. The classic 4-year halving cycle still matters, but it's no longer the dominant force. In Alden's view, global liquidity cycles typically running on a 2.5 to 3-year rhythm have become the primary engine behind Bitcoin's bull and bear markets. This shift means Bitcoin is now more tied to macro conditions than ever before. As liquidity expands or contracts globally, Bitcoin responds not just to block reward reductions, but to the movement of capital across the entire financial system. Alden argues that understanding this new dynamic is essential. The next phase of Bitcoin's evolution will be shaped not just by supply mechanics, but by the global flow of liquidity itself. And before that, be the one who says I was here before 100K. I'm on a mission to hit 100K subscriber before 2025 ends. Help me get there. Subscribe now and drop your thoughts on the market in the comment. Let's win and grow together.
So my base case is that the cycle's still in place, but that the cycles are changing over time. Even before this cycle, I published research kind of arguing that Bitcoin has correlated more closely with liquidity than anything else. Going back several years, liquidity cycles on average are about 3 years. And Bitcoin's bull markets, even though there's been like one bull market per 4-year halving cycle, the length of those bull markets varies. Sometimes it goes from lows to highs very quickly. Other times it takes longer. And that length of time is actually kind of correlated with what's going on with liquidity, for the most part. As Bitcoin becomes a larger market, so it's a larger, more liquid, we're talking a $2 trillion market now. It's more integrated with the traditional finance system rather than, almost entirely disconnected from it as it used to be. I do think that some of the extremes are being removed from it. It's easier for a tiny illiquid asset to have extreme price moves than a larger and more liquid and widely held asset. And so I'm not surprised to see that this cycle is more prolonged. But so far, I think it's on track. I mean, it continues to follow global liquidity measures as we'd expect. I do think that the 4-year halving cycle is increasingly less relevant because mining rewards are now a much smaller share of available coins. And instead, it's mostly about what price will unlock older coins. And so kind of the metrics that I track are, one, the market value to on-chain cost basis, to kind of see, how much euphoria is in the market at a given time. And then I also track like the HODL waves. So generally speaking, when you have bull markets, the percentage of coins that haven't moved in more than a year or two starts to fall, because some of those older coin holders that are deeply in the money now, they tend to start trimming into that strength. And we've been seeing it this cycle, just like past cycles. So I think the cycles, those cycles continue to matter, even as maybe the halving cycle matters a lot less than it used to. So my personal opinion is we've not peaked yet. And going back to the prior kind of metric that I mentioned, market value compared to on-chain cost basis, the reason that's useful is you can picture, say, a house, like a street with like 50 houses on it. And let's say none of those houses changed hands in a while, and then someone buys one of those houses at a much higher price than it sold for last time. Generally, what will happen is all houses on that street will go up in perceived price because one of their comparable sales changed. And yet a very small percentage of the houses changed hands at that new price. And so that's kind of an illiquid price. It's unclear what would happen if multiple people on that street, wanted to sell their house. And so not until you kind of are at that new price level for a while and there are multiple house sales would you kind of consider that the new true price of houses on that street? And Bitcoin is obviously much more liquid than that, but it does a similar dynamic where if it jumps very quickly, with a pretty small number of coins that kind of changed hands and now we kind of reset the price of the entire market cap, that's not necessarily the real price if more coins want to move. And so that's why I look at the market value compared to on-chain cost basis, because when that gets really far ahead of itself, you're more likely to get a correction. And in the prior major cycle tops, including 2021, that ratio reached extreme levels. So basically, the market value increased way faster than the on-chain cost basis, and then it took a lot of time for that to be digested. When we look at this cycle, we've not reached anywhere near those prior peaks of metrics like that. We've kind of reached, say, mid-levels of that metric, and none of the metrics so far show anything of extreme sentiment like we see at prior cycle peaks, including 2021. I think it'd be disappointing if we don't see at least 150K. I'm hesitant to give a much higher price targets because you could certainly reach there. But I try to take, one step at a time. And so I think that by most metrics, I'd be surprised if we don't see another, 30+% move, or more that would get us up to that kind of, that higher level. There are certainly higher numbers that I wouldn't be surprised at all. I'll reassess if we reach those numbers to see if there's still more to go. But basically, I think we're in a longer cycle, maybe less extreme, but still, summers and winters, still bull markets and bear markets, and I tie them less to the 4-year halving cycle and more toward pockets of euphoria, pockets of depression, as well as the supply demand cycle. So what kind of higher prices unlock older coins, and what kind of consolidations stop those older coins from getting to the market? I'd say most metrics suggest higher from here, at least moderately.
Turning to the macro picture, Lyn Alden delivers a blunt assessment. U.S. deficits aren't going away, they're structural, not cyclical. Unlike past shortfalls tied to recessions or temporary slowdowns, today's deficits are baked into the system. The primary driver, demographics. As baby boomers retire, they withdraw more from entitlement programs like Social Security and Medicare, while contributing less in taxes. Even with solid GDP growth and low unemployment, the math no longer balances. This isn't just a fiscal problem, it's a monetary one. Persistent deficits increase the pressure on policymakers to monetize debt over time, and that, Alden explains, creates a long-term environment of currency debasement. In that world, owning hard assets, especially Bitcoin and gold, becomes less of a hedge and more of a necessity.
I would view it as the opposite. It de-risked it slightly. So it took away a discount. And so basically when people and institutions invest in Bitcoin, they're pricing in some non-zero tail risk that the government's really going to crack down on it at some point. It's, even in recent years under the Biden administration, it's kind of been at the periphery of the market. In order to get the spot ETFs in place, literally the SEC had to be sued. And banks have been very restricted in what they can do with it. And I think the market correctly saw that in this current administration, that's less likely to happen. So they priced out a discount that was in. Now, obviously, in 3.5 years, some of that could be reversed based on election outcomes. That's a pretty far time away. And also, the bigger and more liquid the asset gets, the less relevant governments are for managing it, because at that point, the donors own it, the banks own it, it's tied in the financial system. So every kind of 4 years you give it to keep growing, makes it so the next 4 years kind of matters less from a political standpoint. So I'm not really worried about there being a political premium in it, even though obviously the election outcomes do matter for the asset class. Well, leverage is always a risk. And this is, this type of thing has been going on in currency markets for a long time. A carry trade where people will borrow in one currency that they perceive as weak, and they'll use it to get another currency that is either higher yielding or likely to appreciate relative to the currency that they're borrowing. And it tends to be a rather leveraged trade. Bitcoin is similar. It doesn't pay any native yield, but it's scarce and has a lot of price appreciation potential. And so much like you would borrow an emerging market currency and try to buy dollars, there are entities that are arbitraging this by borrowing dollars and using it to buy a much harder asset in Bitcoin. So I think Bitcoin Treasury companies make a lot of sense. And there's trillions of dollars of managed capital that is kind of like in walled gardens. These are like asset managers, 401ks, insurance companies. There's all these kind of this big pools of capital that can't really leave their ecosystem too much. They can't go on chain to Bitcoin. And so giving them various securities, whether it's an ETF or whether it's a corporation or whether it's a debt instrument from a corporation, that allows all those different types of managers, whether it's a stock manager, bond manager, discretionary macro manager, to be able to express a bullish view on Bitcoin. So I think it's totally normal. And yet I do think that by the end of the cycle, I mean, I'd be surprised if we don't see at least one of these blow up. It comes down to some of these are going to buy in late when there's more signs of euphoria in the market. Some of them might not term out their debt appropriately. So we saw before MicroStrategy got through the prior bear market because they appropriately termed out their debt and they continue to term out their debt. There could be newer entrants that don't manage this as well. They get overeager. They're less savvy the way they construct things. That's certainly possible. So I do think that like any decent trend, it'll be taken to excess. Usually trends don't just kind of stop midway. They make sense initially and then they get taken to excess, or kind of too much happens too quickly. So I do fully expect that, when we're kind of looking back and saying, why is there a bear market? Why did this cycle end? It will probably be tied to these treasury companies in some way, which is not to say that the treasury companies shouldn't be doing what they're doing. It's just that there's going to be some later or less savvy entities that do it improperly, and the leverage comes back to hit them. U.S. fiscal deficits are pretty intractable. And so regardless of election outcomes, because I was saying this before and after the election, there's very few ways to meaningfully reduce the deficit in any sort of investable time horizon. So call it 5 to 10 years. And therefore, I had the view that this is going to be very persistent, and therefore the market impacts from those deficits are likely to continue. So the main metrics I look at, one of them is demographics. So as the baby boomers started entering retirement years in the late 2010s at scale, there started to be a drawdown of Social Security, for example. And we started to see a disconnect where normally fiscal deficits are higher during periods of high unemployment, and they're lower during periods of low unemployment. And we got a disconnect from that. So we started to see large deficits even during periods of low unemployment. And so they're disconnected from the economic cycle because they're more tied to demographics, more seniors collecting Social Security and Medicare and paying less into the system. And so that's a fundamental change.
Alden draws an interesting parallel between Bitcoin and currency carry trades. In foreign exchange markets, investors typically borrow in weaker currencies to invest in stronger, more stable ones. Bitcoin, she argues, is increasingly viewed as the strong currency in this dynamic, a form of hard money that capital seeks out. When fleeing debasement or volatility, institutions may not be positioned to custody Bitcoin directly, but that's no longer a barrier. With the rise of ETFs, Bitcoin-linked bonds, and other structured products, exposure is now accessible across traditional financial vehicles. This opens the door for massive capital pools, pensions, insurers, sovereign wealth funds to participate in Bitcoin's upside, without the operational friction of self-custody. As a result, Bitcoin isn't just a retail-driven asset anymore, it's becoming a core option in institutional macro strategy. Click this video to see what happens next.